Good morning, everyone, and welcome to this presentation on Fidelity China Special Situations. Shortly, we'll be hearing from manager Dale Nicholls on the portfolio and his outlook for China, which we think is looking increasingly interesting on valuation grounds. You will no doubt have seen the announcement on Tuesday about the proposed combination with Aberdeen China. We also have Mike Balfour, chairman, with us today to speak about this and to answer any questions. We expect the presentation to be 25 to 30 minutes, and then we'll open it up to questions. If you're in the audience, you'll be on mute, but you can write your question in the box on the right, and we will put those to Dale and Mike at the end. So with that, I will hand over to Dale.
Fantastic. Thanks, Thomas. So it's great to connect with everyone and, share a little bit about, the sort of market environment that I see, how I'm positioned for that. And obviously, as part of that, I'll be touching on, some of the macro factors and regulatory factors that sort of drive that positioning. I realize that I'm probably speaking to some new investors, so I was asked to just give a little bit of background of myself and also the process by which we select stocks and basically build the portfolio. So we've included just a few slides on that to kick off with. Let's get into it. We can just go to I'm controlling the slides. Is that a disclaimer? So yeah, just onto my background. As you see here, I've been with Fidelity over 25 years. It's, I guess, kind of a traditional Fidelity background. Started as an analyst in Tokyo. You work through a number of different sectors. Towards the end of my time as an analyst, I was actually running some small investment trusts in Japan, but it was in 2003 that I took on the Pacific Fund, an open-ended fund that I still run. Through that period, obviously, I'm looking at the region, but China has been a major focus. I've always found it a great stock picking market. We'll get into the reasons why, but you have a market that is often driven by headlines. There's a lot of concerns around macro, etc. So you've actually got a market that's fairly volatile. And it's volatile at the stock level. It's also actually volatile in terms of what's happening on the ground. There's a lot of change that's happening, and there's a lot of great companies that are being formed through that process. And often, again, through that volatility, you get some pretty significant swings in valuation. So as a bottom-up stock picker, it's actually it's a really good market for picking stocks. And that's very much what I'm focused on. We'll get a little bit into the process, but as part of that, I think that focus, when the opportunity came up to take on Fidelity Special Situations in 2014, was lucky enough to be selected by the board to take on that from Anthony. And yeah, it's coming up on a decade, but it's been a great experience. Obviously, again, very volatile, and we're definitely in terms of timing now at that point in time where there's a lot of negativity, a lot of concern, but there's a lot that's happening that's very positive at the stock level, and that's what's making me quite positive in terms of the outlook from here. So getting into that, and I said, as I mentioned, I run open-ended funds as well, but there's a lot of benefits that come from running a closed-end vehicle. So in terms of style, I definitely have a mid to small cap bias. Basically, the basic premise for me there is as companies are smaller, there's less information. With less information comes more mispricing. So I really want to capitalize on that. I leverage our significant team that we have on the ground to capitalize on that. So again, that closed-end structure allows me to go down the cap curve. I can take time building positions, and again, it's something that we'll show in terms of if you look at that exposure that I have to the mid to small cap part of the market. At the same time, we can gear. So as you see here, net gearing 1 to 5. So, this is definitely high from a historical perspective. You'll see the chart that we have in the pack, and how that's varied over time. But again, I can capitalize on the opportunities in the market, through leverage. And we're at a stage now, as I've said, where there's a lot of value in the market. There's a lot of opportunity, and I'm using that. And that's why the gearing at this stage is at the higher end of where it has been historically. Again, with that closed-end nature in terms of the benefits it provides in terms of liquidity, we can own unlisted companies as well. Our goal is really to capitalize on the broader set of opportunities that we can. So a lot of the companies, I guess there's a trend globally that companies are coming to market later, and so it's important we're able to access those opportunities. We use the same analyst team to really capitalize on those opportunities. We'll talk about some of the individual positions, but I think that's something that really distinguishes us. If you think of a company like ByteDance, which is a major player in the internet space in China, to not be able to access that, I think would be quite limiting, in a market like China. So, we definitely capitalize on the opportunities that we see in the private space as well. And at the same time, we're looking across the whole market. Not everything is a buy. In fact, some of them we have pretty strong conviction on the sell side, so we can capitalize on that through options and shorts. Just a few thoughts, over on the overall investment process, and what I really want to highlight here is that this process is my process, but I'm leveraging our team of analysts. That's really the engine room for our research on the market. We've got close to 40 analysts that have at least some China coverage in terms of the sector that they cover. Generally, an analyst will get a particular sector, and we've got approaching 30 analysts that are purely focused on China. So this is the team that I work with every day to really build conviction around opportunities in the market. So the ideas come from a range of sources. I spread the net very wide. I'm meeting companies all the time. And in meeting companies, I'm always trying to come up with a real understanding of industry structure. Who the winners are, who the losers are, who's gaining share, and why. That's really key. In analyzing any individual company, there's a few core things that I focus on. I say growth, but I'm really thinking about scale of a business, thinking about how big can a business be, in 5, 10, 15 years, given the opportunity set and how a company is set up to capitalize on that opportunity. There's a lot of businesses that grow a lot, but aren't, generating great returns. So I'm really thinking about the quality of a business as well. In other words, how, the company's moat and how that's changing. And ideally, those two things come together. You've got a company that's, generating high incremental returns on capital that they're reinvesting in the growth opportunity. And the final factor is management. You can have the opportunity and you can have a great business, but management really needs to execute. So again, we leverage, the significant team that we have to be constantly engaging with companies and making sure they are executing, on the potential and the investment thesis that that we've laid out. So that's basically how we select stocks. They go, generally we generally build conviction over time, so we can start with small positions, but positions can build over time. And the basic, I guess the core around any the thinking about sizing in the position is about risk reward. That's sort of the key factor that will decide positioning. So thinking about potential upside versus downside. And obviously valuation is a key factor there. And as you said here, this is a reiterative process. We're constantly revisiting, the holdings in the portfolio and thinking about, the position size and where they should stack up in the portfolio. Right. So we'll move on to just some of the sort of, the factors, the broad factors behind how I'm looking at the market. We have this chart here because we've been through what has been a relatively tough period from a regulatory perspective, and that is definitely, I think, a factor that has impacted multiples and the overall market. I like this chart because it does show that clearly the regulatory tightening that we've been through is probably the deepest and longest that we've seen, but there is cyclicality to this. You have periods of tightening, and then you have periods of loosening. And what I'm showing here is that we're definitely in a stage of policy loosening now. There's a much greater focus on growth, and I think that process continues to play out, as you see in this chart. So again, it's something that has, I think, held the market back, but I think sometimes this cyclicality is lost. And again, I also like this because this is we like to think of things in the long term, and I think it's important to keep in mind China's long-term goals. Obviously, there's a goal to double GDP per capita again, and you're really not going to achieve that without a vibrant private sector and growth. And I think the policy shift now is definitely moving towards one that's more about growth as opposed to tightening. So onto the broader economy. These numbers are obviously impacted by COVID. It's important to keep in mind that the economy, we're clearly locked up for a couple of years, and now things have reopened. Earlier this year, I think there was fairly strong momentum, but definitely from the second quarter, things have slowed. I think this is sort of an internal sort of activity indicator that we use to track the overall economy. Although it is bumpy, I think it's important to highlight that I think that the general direction clearly is towards one more of recovery. If you look at the components there, clearly services are on the stronger side, and I guess not surprisingly, again, with people locked up for some time, I think the sort of more experienced part of consumption is an area that is likely to grow faster and has actually been growing faster. But it is a bumpy road. The most recent PMIs on the services side were slightly disappointing. The other factor that you can see here is industrials. That is bumpy as well. There's I think we talk a lot about consumer confidence, and you've seen the broader consumer confidence numbers that have been relatively weak. Business confidence also has been relatively weak. And when we analyze the factors behind that, I think what's happening in the property sector is clearly a driver there. And you can see how property has been a drag. But again, in terms of the regulatory side, clearly actions are being taken to deal with that. And it's almost daily that sort of other actions are coming out, often by city. You just saw Shenzhen come out and lowering the deposit requirements on second homes there. I think you continue to see that type of action, and I think that's definitely important in terms of improving overall sentiment. On the business side, but also really at the consumer side as well. So I'm looking at individual companies, but I do have sort of you do have to consider the macro backdrop, and I do think the potential is there for things to gradually improve in terms of overall confidence. Another factor that I think has hurt overall consumer confidence is you had some pretty well publicized job cuts, particularly with the big tech companies. Again, when we're looking at the tech companies now, we think the biggest part of that is behind us. Incidentally, that's actually driving earnings upgrades for a lot of the big tech companies, but it hasn't helped in terms of consumer sentiment. But again, looking forward, I think the potential is there for things to gradually improve. And I'll just move on to the next slide. When you look at the consumer balance sheet, we do have that concern about property, and obviously property is a pretty significant component in the consumer balance sheet. But I think it's worth focusing on just the increase that we've seen in deposits on the consumer balance sheet. And these are big numbers. If we're talking about trillions of RMB, and you can just see how much that has increased over COVID. So the consumer balance sheet is in good shape. So again, with some stabilization in confidence, I think the firepower is there for consumption to come back. And again, I'm not building in huge recovery into my base case assumptions, but I do think the potential is there if we do see some stabilization in overall confidence. So delving a bit deeper into the property sector, again, it's you can see that it's a bumpy recovery, but I do think it is the general trend is towards one of stabilization. You can see I guess the key thing to focus here most importantly is on contract sales, so the green line, because that's what's driving future construction. But I think it's also worth focusing on completions as well. Again, I think there's been concern about for people that have bought houses and you haven't seen the projects actually completed. I think there's a lot of focus on getting these projects completed, and that's what again, you see a lot of support for developers, increasing support for developers, particularly on the private side. And particularly more recently, you may have seen the new, I guess, the list of 50 companies where you've got explicit I guess policy to support these companies, mostly focused on the banks in terms of getting the funding there to complete projects. And again, I think that is important in improving overall consumer sentiment. We focused on the sort of overall the factors driving improved sentiment. Clearly the overall levels of interest rates is a factor there as well, and you can see how as deposit rates or actual lending rates have come down, there is a recovery, particularly in the secondary part of the market. That may reflect again, if we think about that shift more to secondary, I think there's probably some element of concern around completions of primary projects. But in any sense, it does show that demand is there, and there is I do think there's some pent-up demand just given the weak sales that we've seen. And again, I guess the somewhat of a silver lining for the troubles that we've seen for a lot of the developers is lower supply. And again, with lower supply, I do think there's potential for pricing to stabilize, and that stabilization of pricing is again positive for I think a better outlook for consumer confidence. Moving on to sort of some of the broader themes that we see when we're meeting with companies, and the pace of innovation really has continued even through this slowdown, through COVID. We see companies continuing to invest in the businesses. We'll show some charts on sort of overall R&D spend, but it's encouraging to see companies are really trying to build a competitive advantage. We see it across a range of sectors, whether it's the industrials, healthcare, etc. But it's definitely a strong trend. And again, trying to show this in numbers, we've got some charts here around overall patent activity. So you can see sort of the level of patents that are being filed. So China approaching basically 50% of all patents filed globally, and this isn't this is sort of, I guess, one indication that we try to show of just again that sort of overall trend of companies investing in their businesses and really trying to build competitive advantage. As I mentioned earlier, looking at that R&D spend, even through the weakness that we've seen this year, we're still seeing double-digit growth in sort of overall R&D spend. It has slowed a little bit in the second half, but this is something that really should flow into again competitive advantage, pricing power down the road. So I do think this is a positive trend. It clearly it does impact the cost base of companies, but importantly, I think it's a leading indicator of, again, pricing power and competitive advantage in the longer term. And on the right-hand side, just looking at what's happening in the healthcare sector as well, and you can see how China's share of overall drug pipelines continues to rise. Healthcare is a real area of focus, and it's an area of focus for us in the trust as well. So, I sort of opened by talking about that swing in sentiment that you see over time in China. That's clearly being reflected in valuations. So, if you think about that, I guess that shift you often see in markets between greed and fear, we're clearly in the fear part of that sort of sentiment cycle now, and that's driven valuations to very very compelling levels. If you look at MSCI China, you can see if we put standard deviation bands around these valuations, we're sort of clearly beyond one standard deviation versus historical levels, and I think it's also worth highlighting that that discount of China to other markets. So here we're showing that discount to US markets again reaching pretty extreme levels, and it's reaching those levels despite earnings growth that actually stacks up pretty well. We're on track for pretty close to 10%, if not higher, earnings growth this year. I spoke of the big tech companies. They're actually companies that are seeing earnings upgrades again, despite a relatively weak overall sort of macro environment. And as we look to next year as well, consensus is generally around that sort of 10% level, which again I think will stack up pretty well relative to a lot of Western economies where we're having the discussion about what sort of a landing we're going to be having in big economies like the US. So again, on a comparative basis, I think that will stack up pretty well relative to those bigger markets. Here we have the performance since launch. We'll get into a little bit of the attribution behind that. You can see that it's the last 3 years has been a relatively tough period. Clearly better if we look at on a 12-month basis. I think what's encouraging for us when we break down what's driven performance over time is that it's the stock picking is what's delivering that better performance versus the market over time. And again, that's leveraging the team that we have, and really trying to just select the best stocks. The gearing, in a weak market, the gearing that we've had in the portfolio, obviously being geared into a relatively weak market has been a drag. But the hope will be that with better markets, that can start to contribute as well, with some stabilization in markets. Just showing the performance in each year. And here we have just the discount to NAV for the share price. Again, I think this reflects the sentiment swings that we've seen in the market, and as we know, we're sort of at a stage now where sentiment is bad, and that's has pushed the discount out as well. We're lucky to have Mike on the call because the board continues to be active in the market, buying back stock during this period, just given the confidence that we have around our ability to grow the NAV over time, and the likelihood that that sentiment can improve and that gap can close over time. As I said earlier, that ability to adjust gearing over time is something that I really try to use in the trust. So it's not a perfect inverse correlation here, but obviously we've got the overall valuation for the market. Clearly, when things are cheap, sentiment is bad. you know, where generally that's when you see the leverage pick up, because clearly finding a lot more opportunity in the market, a lot of value, and you know, we're clearly in that phase right now, and that's what's pushing gearing up to a relatively high level currently. We just also want to highlight, as I mentioned earlier, we do really spread the net wide, looking for the best opportunities in the market. That smaller part of the market is the area that's less well covered, where, you know, there's more mispricing and I think more opportunity. And it's across styles as well, as you can see. You know, there's opportunities across, you know, both the growth part of the market and the value part of the market. So as I mentioned earlier, everything is about risk reward. And, you know, we're finding it, you know, those opportunities across really all parts of the market. So in terms of sector positioning, you'll see where the biggest bets are relative to the index. Industrials, you know, this I think reflects a lot of that innovation trends that we're seeing. We're seeing, you know, the emergence of just really strong quality companies. I think there's other factors behind that as well. You know, there's definite domestic substitution across a range of industries in China. There's a lot of talk of, you know, the bifurcation of supply chains, and the potential negative impact that can have on Chinese companies, but it's actually benefiting some companies as well. There's, you know, there's still big sectors that are often dominated by foreign players. If you think about areas like robotics, you know, there's still the foreign players that would be the market leaders, but you know, the domestic players are definitely closing the gap, and there's you know, strong support from a lot of companies domestically to use domestic suppliers. So that's a driver. There's also great consolidation across a range of sectors. There's a lot of industry in China that's still very fragmented. If you think about an area like building materials, you know, whether it's paint, waterproofing materials, pipes, etc. You know, generally your top 3 players are around that 20 to 30% sort of levels of concentration. In the West, that tends to be around 80%. So there's, you know, I think that will happen over time. It's probably accelerating through this slowdown. But we're seeing the emergence of really strong domestic players. And given those levels of market share, there's really strong growth stories that can play out over, again, the next 5, 10, 15 years. Healthcare, as I've said, a lot of innovation happening in that sector, some really strong companies that are coming through. And it's a strong, you know, there's areas of the market where you've just got very low penetration relative to a lot of sort of Western economies, and areas that should grow pretty significantly over time, whether it's in, you know, just, you know, core pharmaceuticals, devices, etc. So, you know, healthcare is a real growth area, you know, for the economy over the midterm. And then we have the IT names, you know, some really quality companies there, and also a lot of valuation support in a lot of these companies. If you look at the big, you know, e-commerce companies, a lot of them, when you factor out cash and their other businesses, are trading in you know, sort of mid-single-digit multiples. Which again, when we think about that discount relative to global peers, it's really quite significant. And there's some really, you know, pretty significant growth potential in a lot of these markets as well. You know, if you think about, you know, things like cloud penetration, very low relative to other parts of the world. So good growth potential there. And the consumer will always feature. You know, if we think about sort of China over the midterm, clearly there's a, you know, a desire to change, you know, shift the overall structure of the economy away from a reliance on investment, particularly debt-led investment, reliance on net exports, to, you know, what we'd call better quality growth driven by consumption. That's one factor, but you know, that, you know, you've also got a broader trend of just sort of the natural growth of the middle class. So that's definitely going to create opportunities in the consumer space, and we're seeing the emergence of some pretty strong domestic brands. I'll leave that there and just move on to, you know, some of the individual names. We've got, you know, sort of the overall positioning on the left, and then you've got the active bets, the ranking of active bets on the right-hand side. I won't go into all the individual names here. If people have questions, I'm very happy to sort of run through the thesis on these companies. What I will highlight is just the emergence of those private companies. You see Pony AI, the leader in autonomous driving in China, actually running actual services. In terms of completely driverless cars. It's very early stage, but they definitely lead in terms of licensing relative to peers, and are very well positioned for a market that is going to be really significant over the midterm. You see names like DJI there as well, and ByteDance, which I touched on earlier. But clearly names that span a range of sectors. We talked about healthcare. You've got names like Wuxi Aptech, a real leader in the overall CDMO space globally, really, and a roster of clients globally. A very strong player in that space. Again, very happy to touch on any of the sort of individual stocks there if people would like to learn more. I will hand over this part to Mike to touch on the most recent transaction.
Great, thanks, Dale. Good morning, everybody. You will have seen, or some will have seen, the announcement on Tuesday morning that there's a plan to merge the company with Aberdeen China. And I just wanted to have a moment of your time to really elaborate on that and to answer any questions that you had afterwards. I mean, the main thrust for this deal is to keep costs down. We have a low ongoing charges ratio for the company and wanted to maintain that. So we have producing a company that has more assets and the costs spread over that larger asset base. It provides greater liquidity. We hope that investors coming over from Aberdeen China will add around £150 million in assets to the company, and that maintains higher levels of liquidity, which is important for many investors. It's as private client investment managers get bigger, investment trusts really need to get bigger also to continue to be attractive to those potential investors. It also allows Dale and the team to add to the unlisted portfolio. We have a limit of 15% of the portfolio in unlisteds. We've been successful over the last 18 months in floating some of those companies. We're down to, I think, Dale, correct me if I'm wrong, about six unlisted companies just now, and it's always useful to have a greater diversification of unlisted companies, so perhaps the numbers there can increase. We got lower fee levels have been negotiated at higher asset levels. So as the company gets bigger, hopefully, with a positive market, shareholders will benefit from lower fee levels at the higher asset levels. And also we're introducing a 5-year continuation vote, so that in 5 years' time, investors will have the chance to confirm whether the company is doing sufficiently well for them to continue to have confidence and invest along with the company. So those are some of the main reasons that Fidelity China shareholders will benefit in the longer term. I also think an important part in how we differentiate ourselves, I think Dale has outlined some of our differentiation factors with gearing and unlisteds and exposure to small and medium-sized companies. Another differentiator for us is this active buyback policy that Dale alluded to, and we do have a policy to try and keep the discount in single digits. And that requires us to go into the market and buy shares back when the discount's greater than that. And adding £150 million to the assets of the company allows us to do that to a greater extent and for a longer time. Our competitors in the China closed-end sector are significantly smaller companies than us, and they don't buy back shares, and that limits liquidity, and it also doesn't add so much value as I think that Fidelity China does. If we buy back shares at a 10% discount, we're adding to the net asset value as we do so. So there's it was quite an important factor in our thinking, is to maintain our size advantage over others in the sector, and that's important for many of the investors we're seeking to attract. So I hope that gives a bit of an outline as to why we're contemplating this. It needs support, it needs shareholder support, and for those that are on the call that are shareholders, I hope you would vote in favour of it when the papers are issued in a couple of months' time. Thank you.
Thanks, Mike, and thank you, Dale, for your presentation. We do have a few questions that have already come in from the audience, but if you're on there, there's still time to add your questions, so please do, and we'll try and put them all across. We did have a question on the benefits of the merger, but Mike, I think you're quite detailed on that. So David, if you're in the audience and you want to ask a follow-up question, please do. We have one question on the combined portfolio. So are there any names in ACIC which are not in FCSS, so in Aberdeen, China, which are not in Fidelity China Special Sits, which, Dale, you're keen to keep? And will the portfolio transition happen before or post-merger?
I think the answer to that is generally no. We think we've got pretty strong coverage of the market, and as I've talked about, we think our positioning is pretty strong. So the general thinking will be to replicate what we already have in FCSS. To be honest, that will be the basic approach. There might be potential to throw up some names that we might do some more work on, but I think the general approach will be, we've got the portfolio that we like right now, and we'll be looking to duplicate that.
And in terms of the combination of the portfolios, will that all happen after the merger goes through, or will there be a transition phase?
I think if I answer that, I think the general plan is that as we get closer to transaction time and shareholder votes come in, then we would work with Aberdeen to align the two portfolios as closely as Dale wants the positions to be. There will be overlap. There's good companies in both portfolios, but a lot of the alignment will probably happen. I hope will happen before the split. The cash goes into one bucket, and the portfolio goes into the Fidelity China bucket.
And question for Mike: Would you be interested in doing more M&A in your sector?
One thing at a time. I would say, well, there's four China closed-end companies in the sector just now. Aberdeen and us merging will bring it down to 3. There's JP Morgan and there's Baillie Gifford. It's healthy to have a variety of companies in the sector. In this particular sector, I was limited chance of more corporate activity, I would say. I think the Aberdeen situation was unique, really. I don't think that this transaction is no negative reflection of Aberdeen and their performance. There's no negative reflection on the board, in fact, because I think both have done a pretty decent job. It's just that they had a very concentrated shareholder list, and those shareholders wanted a bit more liquidity. And the same circumstances don't, I believe, exist with the other two.
And will there be a cost to shareholders of the transaction in terms of, I guess, turning over the portfolio of Aberdeen China?
It's one of these complex elements of the deal that, and it sounds too good to be true, but actually both sets of shareholders are not penalised by the costs. The Fidelity are contributing a fee holiday for 8 months on the assets that come over, and they're also contributing £500,000 to the costs of our advisors at Fidelity China. On the Aberdeen side of things, those that are taking cash will be taking cash at a 2% discount to the formula asset value, and that 2% covers, I think, almost all of their costs. Now, there may be other things like tax and other things that may be in the pipeline, but I think, as planned, there's very little costs to shareholders of either side.
Great. We had a couple of questions on the gearing, which may be worth asking together. So I guess one, given that gearing is very high, can we take it that, Dale, you are as optimistic as you have been for the future returns? And then secondly, with regard to the combination and the maturing of a facility in February, does that impact the gearing level that you would carry going forward?
Right. So for the first question, yes, it does. This is a time when, I'm finding a lot of value in the market. We're seeing valuations, frankly, that we haven't seen for a lot of companies. I know sentiment is weak, but, it's generally those periods where, the best opportunities are presented. So it definitely does reflect a lot of opportunity that I'm seeing in the market. So that's, definitely one thing. In terms of the facility that's expiring and maturing, that shouldn't change overall gearing at all. It's really not going to change the strategy. It shouldn't be impacted at all.
Great. So turning to the portfolio then, or the outlook for China, do you have any concerns about political tension from the UK side, especially with Labour discussing a UK-China audit if they win next year?
Yeah, I don't really. I don't really see how that's going to impact a lot of the companies that I look at and have in the portfolio in terms of their outlook. Generally the focus of the companies in the portfolio is around, companies that are focused on the domestic opportunity. We've talked about areas like consolidation. We've talked about domestic consumption. Some may have, there will be export exposure for some companies, but the vast majority of companies, again, are focused on the domestic opportunity. So, I don't see how that's going to be a big factor for the vast majority of the portfolio.
And we had a question about Tencent. What's your view on the outlook for Tencent?
The outlook is pretty strong. There's obviously with the WeChat business, it's an incredible asset, and it can be monetized in many ways. Obviously they're a new player. Well, not a new player, but they're really growing in the short form video space, and that has great monetization potential. It's under monetized currently, so that's going to be a big growth driver going forward. At the same time, obviously a very, very strong gaming business. Personally, I'm still pretty bullish about the potential for growth in gaming. If you think about sort of other, sort of general forms of entertainment, I think it's an area that can continue to develop. So, combined with a pretty decent pipeline of games, I think the outlook there is relatively solid as well. And then the financial part of the business as well, with a gradually recovering economy, I think there's potential upside there as well. So in general, I think the outlook is pretty solid.
And sticking with tech, it's been noted that you've reduced your position in Alibaba recently. Is that a sign that you're moving away from tech and consumer discretionary? Is the portfolio shape changing?
Not really. I mean, if you think about sort of overall exposure to consumer discretionary, it's actually one of the big areas that I have reduced over the past 12 months. As I showed earlier, I am overweight, but we've actually had some companies do pretty well. I mean, when we go through the attribution, consumer discretionary is probably one of the biggest contributors, and we've had some of the stock picks really work out. So the valuations for some of the stocks just aren't as compelling as they were. It's still going to be an area where I think we find a lot of opportunity. I touched on e-commerce earlier. In terms of the lower position in Alibaba, it's no secret that they've had some competitive challenges. In the market, there's some strong competitors that have taken market share. We know what the market share trend has been, over the past few years. They're clearly trying to address that, but it's going to be challenging. You've got some very strong competitors in that area that occupy very strong mind share. So it's going to be challenging. It's going to require some investment on their part. But we still have some money in the portfolio. Obviously we talked about the valuations. The valuations are very compelling. They're clearly doing more to return capital to shareholders. So it still justifies a position in the portfolio. It's just that that competitive pressure is a challenge that they're dealing with in the next couple of years.
We still have a couple of questions that have been submitted, but if you're in the audience, we do have time, so please put your questions forward. When it comes to meeting management of companies in China, it can often be a key part of the investment process, but how do you make judgments given the language and culture barrier? Is it harder to judge character and the like?
Yeah, I mean, this is really a core part of our process, and it's obviously not just me. We've got that team of analysts that I talked about earlier that are on the ground, constantly meeting with management. So generally, when I'm meeting with management, we work as a team. We're both trying to make that assessment of management, and it's evolving. So it's not like you make a decision after one meeting. We meet with management. We really try to understand the strategy, really understand that competitive landscape, and understand again, one is their ability to set strategy, and the other part is their ability to execute. And we track progress. So that track record sort of builds over time. Company, management teams delivering on the strategy of what they plan to do. So bringing that together, I think we're in a really good place to make that judgment relative to a lot of our peers. So I just want to reiterate, it's a team process, and I think we're pretty well positioned to make that judgment.
And when it comes to that analyst team, how regular is your interaction with them, and is their time shared with other managers?
Yeah. I mean, they will. They're sharing their ideas with the broader team, but we have constant interaction. Analysts are incentivized to impact portfolios. Doing the work is one thing, but they're very much incentivized to have impact, for our shareholders. That communication is it's constant. It really is.
We got a question has just snuck in at the end there. Well done on your timing. Is your portfolio positioned for growth in artificial intelligence? You didn't mention it with regard to Tencent.
Yeah, I mean, in terms of artificial intelligence, it's the application is very broad. I mean, in the tech space, all the companies are working on leveraging it. If we're talking about large language models, it's still very unclear in terms of the competitive landscape, to be honest. We're watching it closely. We're obviously watching, sort of developments globally as well. But yeah, I think it's, making a bet on a particular company really leading and developing a sustainable advantage, and really, sort of creating a lot of shareholder value, or corporate value, company value is I still think it's a little bit early to make that call, but it's something that we're really following closely.
Fantastic. Well, thank you very much, Dale, and thank you, Mike, for presenting to us today. Thank you for you in the audience for your questions. This presentation will be available online with the slides, so please do check that out on the website. And with that, I will bring this to a close, and thank you once again, Dale and Mike, for your presentation.
Thanks, Thomas.
Thanks so much.
Good afternoon, everyone. Bye-bye.
Bye-bye.